Hey guys, John deRoulet, Head of Revenue Management Education here at Wheelhouse, and today we're going to do a data deep dive into Steamboat Springs. We're going to be using market data from Wheelhouse, using primarily Wheelhouse's market reports, which are a great high-level view into what's going on in a market area. Just so you know, these market reports are all freely accessible data to anyone, whether you're a Wheelhouse pricing client or not. In addition to that, before I jump in market data, I did want to share with you guys that Wheelhouse does offer our full Performance Insights business intelligence suite for free. What does that mean? Not only can you access all the market data that I show you, but if you need some additional tools to see your own data on your own portfolio, how you're pacing, what your historicals looked like, what you were looking like in terms of where you were at the same time last year, and a great visualizations for where your sales are occurring. Wheelhouse also offers this business intelligence suite to anyone who signs up with Wheelhouse. You do not have to be a Wheelhouse pricing customer. This is fully free. All you have to do is connect your account. We're going to be talking a lot about pace and a lot about comparing what you're seeing in the market to your own portfolio. And if you need some additional tools to do that, shoot us a line. Get signed up, and we're happy to provide you training and support in getting set up on our business intelligence tools. All right. Let's go ahead and hop into some data. So I have the Wheelhouse market report pulled up for Steamboat Springs. This is going to be a high-level kind of market area report. It's a great way for us to see overall trends and kind of what's going on in the market. We're primarily going to be talking about these high-level trends on this call today, but Wheelhouse does have a separate data platform called Dynamic Sets, which allows us to get very specific and look and filter down into specific market areas or specific comp sets. For now, though, this kind of high-level overview is going to be good just to give us an idea of what is going on in the market. So I'm going to hop over here to our trends section, and we're going to take a look at the adjusted occupancy. This trends portion is a really great tool to use to get just a general idea of what's going on. It's going to show us month over month, year over year KPIs, and in this case, occupancy. So we can kind of see a holistic view of what's going on in the market. I think this is one of the best tools to use. I recommend that our clients and other people always do kind of like a macro view, at least on a quarterly basis, so that you have an idea on what direction the market is going. Having a good concept kind of internally of like, do you think things are getting better? Do you think things are getting worse? Do you have some things you're concerned about? Do you have some things that you think are going to be opportunities? Is really good to help you plan what behavior you're going to take when you do your regular revenue management. For example, if you think things are going to get worse, you're likely to be more conservative on rate. You're going to telegraph to your owners what you think is going on, and you're going to cut rates possibly a little earlier, a little bit more than you might if you think things are getting better. If you think things are going to be better, you might be more willing to hold rates. You're going to talk to your owners about why their rate positions might be high, so on and so forth. And occupancy is a great way to this occupancy chart is a great way to see that. In addition to that, I think that these kind of month over month trend reports, especially for occupancy, are a great way to communicate to owners what is going on. There's a lot of complex KPIs in our space, and an owner may not really understand how all of those KPIs come together for the property manager. But something that an owner does understand is occupancy, right? If occupancy is up, it means there's probably a lot of demand and a lot of opportunity. If occupancy is down, it means there's a lot of competition and things probably aren't going as well or according to plan, and so you got to make some changes. Using an occupancy chart like this, you can really communicate to an owner easily if things are better or worse than last year. So let's hop in and kind of take a look at the occupancy chart for Steamboat Springs. I'll point out a few things. Some of them are going to be pretty obvious. Just so you know, we are looking at the entirety of the market here. So we haven't drilled down into any specific performance groups. We're kind of looking at all bedroom counts just because we want to get a general idea of how the market is going. Now, obviously, Q1 is going to be the top season in this market. This big ski market. That's going to be where the majority of the occupancy and the revenue is coming in. And you can see that in this chart in that Q1 is definitely the high season. Now, mud season, pretty low, but we do get a little bump back up in summer. So there's obviously some very strong summer travel here that can support the business and support the revenue situation. And that actually remains fairly strong through the fall. Now, it does kind of have a downward motion into this kind of shoulder, but almost all of the fall months are stronger than those mud season April, May months. Before we kick back up into our ski high season. Now, the first thing to note when we look at this year over year is that Q1 was pretty strong in Steamboat Springs in the sense that we maintained occupancy at the market level and had a little bit of increase in March, while a little bit of a drop in January. So in general, things were pretty stable as we were moving through Q1. However, once we get into April and May and mud season, we start to see a pretty big drop in the occupancy levels, meaning there's quite a bit more pressure. Now, ski season's kind of a unique one because that is going to be so weather dependent. But if you've been paying attention to other markets around the country, around March and April is when people started to notice across a number of markets that there was a lot more pressure on occupancy this year. This is especially true for markets that were exposed to international travel. A few of the broader trends that have been kind of occurring this year is occupancy has been down in a number of markets, and international travel has been down, especially for Canadians. Now, for you guys, the trend is more like, why are markets down consistently for just domestic travel? Domestic travel makes up 90% of travel in the country. And is that continuing? Because it may be an early indicator for you guys for your coming up high season in Q1. Right now, things have seemed to stabilize a little bit since the spring for most of the summer markets. They still are under a little bit of pressure. It's definitely much more competitive than people would like, but people aren't panicking the way that they panicked in the spring when there was starting to seem like pretty big shortfalls. Now, there are some exceptions to this. International travel is still struggling quite a bit, and any market with a lot of international travel is going to be pretty exposed. For you guys in Steamboat Springs, I'm sure you get international travelers, but it's still primarily going to be domestic, so maybe not a huge concern. That's really going to be more of a concern for you if in your own portfolio, in your own CRM, you do a lot of international business. And especially if you have Canadian business, you really need to take a look at that because it's down substantially. Now, for summer, kind of like second high season, like Hobbit style second high season, I would imagine that international travel is not a major driver of business at all, so probably not something you have to be concerned about. But in terms of these trends, we do want to be aware that this April and May occupancy pressure is something we need to be aware of and see if it kind of starts to come back. Now, one of the things that kind of counters that is June was pretty stable, right? So June occupancies, a little bit of attrition here at the market level, but not a substantial amount. So definitely not looking like April and May. It looks like I said, in those summer markets, there's been a little bit more stabilization this year as we get into the summer that maybe is occurring here. And the question is, when we look at July, does that look like it's on track at the market level to get where it needs to be? We're well above 2/3 of what was on the books last year. And, I went ahead and pulled up the pacing information so that we can kind of tell you exactly where it was. What I did is I took this 36%. I went to our historical kind of daily level view and looked at our distribution chart for time. I went to last year's July and I found roughly where we are. We're about 20 days. So 32.9% of bookings or properties booked within that time period. So it's about 66%. And then I went back here and multiplied the 36% by that. I did that work for you. So roughly last year, where we were pacing for July at this time was around 25%. So in fact, this kind of trend, this kicking back up in April and May, back into June, looking pretty stable, is looking a little better in July. The pacing is actually doing a little better here as we get into the peak of summer. So maybe some of the concerns that people had in the spring, we know there was a lot of financial news, maybe caused some interruptions across the country in buying behavior. That settled down a little bit. People feel a little bit more confident purchasing, and we're seeing that kind of come together for July. Once we get into August, though, now August, it starts to turn back down a little bit. There's not a lot on the books. There's only about 8%, so pretty minimal. And when we compare this to where we were last year, we were at about 13%. So we're actually trailing by about half. Pretty big gap in August. So there's a lot of mixed signals here. We have some months in Q1 that are strong. The low season was weak. Summer is kind of on track, but that early pacing is behind. So a lot of kind of difficult decisions here for the revenue manager. I would say for you guys, if you're thinking about this, it really comes down to how you're pacing and what you think is going to happen. If you think things are going to get worse, the market's pacing a little bit behind, even though July is pacing fine. Once we get to August, September, it starts to trail a little bit. Maybe you want to get a little bit more conservative and try to pack on a little extra occupancy. If you think things, we know that there's some pressure still in some of the summer high season markets, maybe you extrapolate that to yourself and decide, hey, whether I'm doing good or I'm doing poorly, I need to make some adjustments and just try to be more conservative on the occupancy side rather than taking the risks on the ADR. The counter to that, too, is if you're pacing behind or you've had some shortfalls and you need to make it up, it could be that there's very strong opportunities if you sacrifice some ADR to just get more heads in beds, especially as you look forward into August, September, and October. Now, in terms of September pacing, pretty much about the same situation as October. We have about half of what we had on the books, a little less than half of or a little more than half of what we had on the books in August. In September last year, we were about 6%. So again, about half of what was on the books for September. Now, one thing I do want to kind of point out here is what's kind of going on in some of the Colorado markets around you. Because one of the trends I think is going on as consumers are being a little tighter with where they spend is markets are competing against each other a little bit more than people might be used to. Now, if you're in a really luxury segment, that's probably not true. But if you're operating kind of like commercial, kind of like more commercialized properties, I think that's definitely true for the consumer, that they're really going to buy according to their budget rather than buy according to their ideal location or ideal property. Again, I think the luxury segment is much more insulated from this, but it does seem to be a trend I've seen, particularly in really dense areas that have a lot of competition. So I think in this case, it's kind of interesting for us just to take a quick glance at a couple nearby markets, Vail and Breckenridge in particular, just an idea of how those are competing. One of the things I want to point out is June and July seem to be pacing pretty well in Steamboat, but those overall occupancies are pretty low, right? 36% at the market level. It's, maybe just over half of what the high season is doing. When we look at a market like Breckenridge and Vail, so I got Vail here and Breckenridge here, you'll notice that these summer occupancies are actually quite a bit higher. So they generally take on more summer occupancy than Steamboat Springs is going to. And when we look at the pacing here, they don't have those little bright spots in June and July like we saw in Steamboat. Breckenridge, the trailing that started in the fall really has continued all the way through June, and they're pacing behind in July by about 4%. So they're down 4% in gross occupancy. And that continues all the way August and September. So they're trailing quite a bit more. In addition to that, we see Vail also has pretty big shortfall in May, another pretty large shortfall in June from the occupancy perspective. And July has an even larger pacing. They're actually pacing 8% behind. So there's some interesting tidbits here where, Steamboat seems to be maintaining, but it's also maintaining a much lower occupancy rate in general. It also probably is not taking much market share, but something to keep in mind, and these conditions could change very rapidly, especially if these shortfalls continue in Vail and Breckenridge. You may see Vail and Breckenridge take the fall and really be competitive, and they may start to take market share from you. So something to really pay attention to in your own pacing is that you have some nearby markets that generally have a higher occupancy rate for these kind of summer and fall months compared to the high season, and they may become very, very competitive against you for those travelers who are really needing to book within their budget, especially if those markets really start to react to the fact that these shortfalls have remained consistent. Now, something else I like to look at is asking rates. Asking rates are the averages of the rates that we're observing that are being advertised on OTAs and that people are putting out through the Wheelhouse system. And so asking rates are a really good view into what the market is doing in response to the demand situation. Occupancy is really great at representing the demand from the consumer in the market. The asking rate is really good at representing what the market is doing, what the market is responding to in terms of demand, and how the market expects things to come together, because it's the price that people are putting out. First thing to note here is we remember that those occupancy rates were really stable last year. And in general, overall asking rates were much higher this year. So generally a pretty good thing. Now, keep in mind, asking rates include both properties that booked because they sold at their asking rate, but also properties that didn't book. So at the market level, there are a lot more properties vacant because not everything is booked in the market. And so you do see some rate increases here, but generally that occupancy remained pretty stable. But once we get into about April, you see a pretty big shift in the market. Now, part of this might be that people in Steamboat and in these areas know that it's not the super high season, so they're not trying to push their rate too much. But they're really not pushing their rate much at all. And kind of in a way, in the fall, they're neither responding to the shortfalls because the rate positions aren't coming down, but they're also not being overly optimistic and trying to push the rate position. Now, this is something that across the country I've seen is actually not as common. A lot of people in our industry keep putting premiums on their rates, even if the market is under occupancy pressure. And I think in a lot of cases, that means that the markets themselves are unoptimized to the consumer. In Steamboat, as we get into this low season in spring and then into this kind of second shoulder high season in summer, we see a much more conservative approach to the pricing. And in a way, that's probably paying off for June and July because we see a lot more stabilization there. Now, in some cases, if you have shortfalls in your own portfolio, you also need to maybe know that the market in general isn't necessarily overpricing or they're not pushing prices. So that might mean you need to take a little bit more drastic action if you need to make up shortfalls. And as we go a little further out, you do see these rates start to crawl up a little. July has a small premium, August has a small premium. And then those premiums kind of start to stack up once we get into September, October, and especially November. It may mean that the market itself in general isn't looking as far out as they maybe could. So if you do need to make up shortfalls, especially if you look in these September and October time periods, you may be able to adjust the rate a little bit, not have to totally undercut yourself, but still, the market is keeping a little bit of a premium on that. And you may have some opportunities to just take market share by being really competitive. If we recall by looking at the occupancy situation, these aren't going to be your high season months, but they're also not worthless either. There is occupancy on the books. You do have time to make small experiments and potentially take some occupancy share if you make some adjustments and are looking that far out. Now, this is something I want to contrast again to Breckenridge and Vail, because in my mind, Steamboat Springs is being pretty conservative about their rate in these non-peak times, which I think is reasonable. It may be that they need to respond a little bit, but summer is showing that they don't need too much response and that the consumer is coming here. Now, again, if you do want to take more market share, undercutting this may be worthwhile. But when we take a look at Vail and then Breckenridge, you can see Vail, despite these shortfalls, they're responding a little bit. They're going a little bit below where they were last year. But then once we get into summer, that response hasn't happened. To me, that indicates that people are waiting till the very last minute to make adjustments. And then as we go further, right? So July, a little bit higher, not much premium, maybe a little bit response. Those premiums grow as we get into August, despite the fact that it's pacing poorly, and they seem to grow even further as we get into September, October. So again, kind of indicating that in Vail, they're not responding they're not quite as conservative, they're not responding as well, and they're not being rewarded in the occupancy. Again, you may expect that just like June ended lower in rate, that there's a situation where prices kind of collapse a little bit in the short term, and that could also affect the demand in Steamboat if these markets' prices start to collapse. When we look at Vail as a contrast, Vail again is pacing behind in the occupancy situation through the summer, and they actually aren't responding super well at all. These rates consistently are being pushed in June, despite the fact that it was behind. The average rate position is a little higher. In July, the average rate position remains higher, even though pacing is behind a little bit. And then as we go forward into August, September, and October, those premiums seem pretty high. So people are being kind of optimistic, or they're not paying attention. And again, what does that mean for Steamboat Springs? It might mean that you may see prices collapse around you, competing in the short term for the occupancy that is available. It means that you also potentially could do the opposite and take market share from them by being really reasonably priced in these time periods that aren't high seasons. Now, one other thing I like to look at is, we're kind of in the middle of this second high season going into another shoulder, but so maybe it's not at the top of people's minds, but there is another time period coming up for us to really start to pay attention to. As you can see here, I've come back to the occupancy situation. And in this case, I'll pull off 2023 and I'll pull off 2024. Well, we'll leave 2024, but I added 2026 this time. And you can see that we are starting to make noticeable occupancy for Q1. So because these high seasons are so popular, people are starting to make their plans earlier. We are starting to see this early occupancy show up, right? At a substantial enough level to be a couple percentage points overall at the market level. This is, I think, really valuable to pay attention to, because when we look at like October or November, which are lower seasons, there's actually more occupancy on the books for January, February, and March than there is for October and November. So we're getting into this time period where you really need to start paying attention to the booking window for your key high season. When we look at the top performing units, so like I switched this to the highest performance group, which is going to look at the top 20-ish% by revenue in the market. Those numbers are even higher. We're at 3.4%, 3.7%, almost 4% occupancy on the books. And that's actually starting to be similar to even September, which is only a few months away in terms of gross occupancy. So right now is the time to really start paying attention to the pacing and being really on top of it, because, you know, at the end of the day, you're going to maximize your revenue by selling this ski season, and it's already starting to show up on the books. One of the things I like to look at here is some of the booking window information, just to kind of get an idea of when to pay attention, right? Now, keep in mind, I'm looking at this at a very high level right now. I'm not filtering down by bedroom counts or anything. When you do this in your own portfolio, you do want to be cognizant of how your own kind of data is going to be influenced by your portfolio, right? So you do want to look at similar portfolio types when you're looking at lead time. You do also want to see how your own kind of booking windows exist in your own data, but it's still helpful to get an idea of kind of when these kind of key points are going to happen at the market level. So I'm going to go over here and we'll just go ahead and choose February 2024 and look at this probability chart. So for February 2024, how did bookings come in the market at the market level? Right now for February, we're about 232 days in advance. So, you know, only about 1% of the bookings were on books at this time. If you recall, when we go to this occupancy, 1% of bookings compared to last year, that was, you know, if we pull a few of these off real quick, 82.1% times 1% is only about 0.82%. Right now, we're at 3.7%. So that pace is looking pretty strong so far for the early booking. That is kind of an interesting tidbit to kind of know, that the market itself seems to be pacing a little bit ahead. Now, if we just look at the top performing listings, that is a little higher. There's about twice as much. So, you know, the top performing listings, the largest listings were closer to 3% on the books. So that's going to be closer to where the market is, but that means the entirety of the market is really pacing a little bit ahead this year so far. Now, something else I like to look at is I like to find a few points that kind of would indicate to me when game time is for revenue management. One of them is I like to find when the first 15 to 20% of occupancy is already on the books in the market. This is the time period where I'm like, okay, hey, I really need to start paying attention to this week to week. I really need to be on top of it because I have time and space to make small adjustments to try to maximize my ADR while still maintaining my pace. In addition to that, it's also the time period where I really want to start reconsidering if I just have premiums on the rate and really be in touch with what I think is going on in the market and if I think the market's going to be strong or weak this year. When we look at these booking windows for, let's go back here to February. When I look at these booking windows and find that 20% mark, that's going to occur around 105 to 110 days. So three months in advance from February. So we're looking at maybe October area is when you want to be really kind of on top of it. If you do the 15% mark, that's going to be a little bit earlier into the 120 to 125 days. Now, keep in mind, I'm looking at high performers right now. So we're looking at just kind of the top, the best booking stuff. And I'm looking at all bedroom counts. It's also valuable if you have primarily big homes to do a similar activity, but switch it so you're looking at the biggest stuff. And when we look at the 15%, it's almost a month further. So 150 days. That means like August right now is when you need to be starting to pay attention. Now, the next time period I like to look at is around the 50% mark. So the average, or better yet, the median, because to me, this is the drop dead zone. This is like when we're in the peak booking and I cannot have my eye off the ball. And I honestly, the goal for me at this point is I need to be on pace, right? And if I think it's going to be a worse year than last year, I need to be ahead of pace. If I think it's going to be a better that year than last year, I'll maybe be okay with being a little behind pace because I think things are going to be over demanded. In this case, we're looking at these large homes and the high performers. That's about 90 days. So from February. So when we're in November, that's like, you got to be on top of it, right? Now, the other point I like to pick is the last 20%. For me, the last 20% is pretty easy. In this case, for these large homes, it's 40 to 45 days. If we look at the entirety of the market, it's going to be pretty short. It's going to be around 25 to 30 days. But that's my drop dead zone, right? That's where I'm like, hey, I'm not going to worry too much about optimizing ADR. I just need to make sure that I'm on pace. And then if I drop ADR, that I'm using it to get ahead of pace to just kind of drive revenue to my bottom line. This is probably the least important time period. And actually, I think this is a big revenue management thing. A lot of people spend most of their revenue management time working on this booking window period. But I actually think it's where you can do the least. You're better off paying attention to where that 50 and that 80% is. But it's still important to note because you don't want to be holding your rates and then suddenly realize you're pacing behind. For you, those are heuristics for me. Finding where the first 20% is on the books, so 80%, finding where the median is at 50%, and finding where the last 20% is going to book to give me timeframes to tell me when to pay attention for my bedroom counts and my kind of markets. For you guys, you can shift that based on your own risk tolerance. Like I said, maybe it's the first 10% that you really want to be on top of it. Maybe it's at 60% because you want to lead the market. Maybe you're willing to take a little more risk, so you're not really going to start paying attention until 40% is on the books, and you're really going to not have your drop dead date till like 85 or 90% on the books. That's kind of up to you, but I think the simple analysis here is that August, that August time period for large homes and down into October for smaller stuff is really when you need to start being on the ball for Q1. Q1 is pacing really well right now. So if you're seeing that in your own portfolio, you really want to be paying attention to it so you can take the most advantage, right? When markets are pacing ahead, that's your opportunity for you to drive ADR. Once those start to stall, or if they start to fall behind, that's when you need to make some adjustments to come back down so you can maintain your sales pace. Right now, it looks like sales pace is really good. We have strong occupancy compared to where we were last year. Take advantage of it now. And if that does stall or it starts to switch, you're going to be looking at it early enough to make those adjustments before the rest of the market. I think that's really key because for a lot of markets around the United States this year, when we were at the end of 2024, early booking was ahead. But somewhere between February and March, that started to flip. And if people weren't paying attention, they got caught behind pace in the last minute, trying to compete with everybody else who had vacancy still. And at the end of the day, there was almost a false sense of security that the market was pacing ahead. So again, you have to compare this to your own properties. You have to compare this to your own performance. And you also have to compare this to what you think is going on in the market. Do you think it's going to get better? Do you think it's going to get worse? All right, guys, I hope you found that deep dive into Steamboat Springs data and some of the nearby Vail and Breckenridge data to be super helpful and super useful for you and helpful in thinking about how to approach the rest of the summer and what's coming up next year. All of the market data I showed you is available for free for anyone who signs up with an account in Wheelhouse. You do not have to be a paying customer. If you would like to deep dive into more neighborhood data, we do have our dynamic sets tool, which will allow you to create custom market reports for specific areas and neighborhoods and types of properties. In addition to that, you heard me talk a lot about pace and a lot about referencing what you see in the market and comparing that to what is going on in your own portfolio. That's a super key part of this step in revenue management. I can't do it for you because I don't have access to your portfolio. But if you need tools to very quickly and very easily see what your occupancy is by month, by week, by day, where you were as of this time last year, and be able to very easily spot where your sales pace is compared to where it was last year, Wheelhouse offers our Performance Analytics Business Intelligence Suite for free. All you have to do is sign up with a free account for Wheelhouse, link your portfolio, and you can access this information, compare it to the market data at just the tip of your fingers. Now, if you want to take advantage of this and you're not exactly sure where to start, reach out to us at Wheelhouse. We're happy to help you get set up, and we provide free training on how to utilize these business intelligence tools and how to integrate them into your regular revenue management process to set you up for success. Anyway, hope you found this helpful and look forward to chatting with you soon. Bye.